central banks are not always sure when to stop raising rates, and therefore their actions might tip economies into recession. Hello and welcome to another episode of MoneyWise. We help you to make sense of the world of personal finance and investing. In today's episode, we're going to look at interest rates. Remember, interest rates affect the world and every player in the game. To understand interest rates, first we have to understand what a central bank is. A central bank is an independent national authority that executes monetary policy and regulates banks. Think of a central bank as the mother of all banks. However, central banks do not directly set interest rates for commercial banks, but rather influences them. In Singapore, the central bank is the Monetary Authority of Singapore, or MAS for short. So, what are interest rates? When it comes to borrowing money, there is a cost called interest. This cost of borrowing money is determined by interest rates. Think of interest as the price of money. When interest rates are low, borrowers are comfortable borrowing more money to invest or spend, while savers are forced to seek alternative investments because they receive low interest on their deposits. However, if interest rates are high, borrowers are discouraged from borrowing more money to invest or spend, while savers are now happy to hold more cash because they receive higher interest on their deposits. The monetary policy set by the central bank influences how interest rates will move. In a game, think of the central bank as the game moderator, who aims to ensure that the game is playable for everyone. Interest rates are one of the key tools used by central banks to achieve their goals, and they usually only adjust rates when the economy is in recession or if the economy overheats and inflation runs high. In a recession, the central bank needs to stimulate growth in the economy. One of their first steps is to lower interest rates. This encourages companies to borrow money and invest in expanding their business, thus creating more jobs. When people have jobs, their financial security increases and they are more willing to spend, which in turn helps fuel economic growth. With interest rates low, especially for an extended period of time, businesses and people tend to borrow more. With the economy awash with cheap money, investment and spending increase significantly. This is why real estate and the stock market rises in value. On the flip side, when a country's economy becomes overheated and consumers find themselves paying steadily increasing prices due to inflation, the central bank moves to increase interest rates. The aim now is to reduce cheap capital and shrink the money supply. This forces companies and people to lower their spending, as they now have to pay more to service their debt obligations. With less money floating around and consumers spending less, prices should stabilize and eventually fall. This is why, in many countries, interest rates have been rising, with several more rate hikes forecasted for the year, as central banks aim to control inflation. Unfortunately, effects from interest rates have a huge time lag. It could be 1 to 2 years before the effect is truly seen. As a result, central banks are not always sure when to stop raising rates, and therefore their actions might tip economies into recession. To wrap up, we have seen why interest rates move and how it is an essential tool for central banks when managing the economy. Join me in the next episode where we will look at how interest rates affect you. Thank you and see you again for another awesome episode of MoneyWise.